What is an IPO? Why do companies go public? Before we understand as to why companies go public, let's build a familiar story around this concept to understand IPOs better. Let us start our story. Imagine a passionate entrepreneur with a business idea to manufacture highly fashionable organic cotton t-shirts. The entrepreneur is confident that the business will click and is enthusiastic about starting the business. But how to fund the idea? Let us assume that the entrepreneur pools some of his money and convinces two good friends to invest in his business. The two friends in this context are referred to as the angel investors. The entrepreneur moves cautiously, hires the right people, establishes the right process, and starts manufacturing high-quality t-shirts. At this stage, the entrepreneur has one small manufacturing unit and one store to retail the product. The entrepreneur's hard work pays off, and the business generates a steady revenue stream. Backed by confidence, the promoter wants to expand the business by adding one more manufacturing unit and a few additional retail stores in the city. The entrepreneur figures out that fresh investment needed for business expansion. The entrepreneur can now access reasonably savvy investors for investing in the business. The investor who typically invests in such an early stage of business is called a venture capitalist, VC. Typically, when new investment flows into the business, the following happens. 1. There is a dilution of shares by the promoter. 2. The valuation of the business increases. 3. All the previous investors tend to make notional profits on their initial investment. As we advance with our story, the company gets an additional manufacturing unit and a few more retail outlets in the city. Years pass by, and the company is phenomenally successful. Now the company plans to increase its production capacity and hire more resources. Whenever a company plans such expenditure to improve the overall business, the expenditure is called capital expenditure, or simply CAPEX. Now the company approached the bank for a loan. The bank would be happy to tender this loan as the company has been doing fairly well. The loan is also called debt. A few years pass by, and the company's success continues to grow. The company decides to raise the bar and branch out across the country. They also diversify the company by manufacturing and retailing fashion accessories, designer cosmetics, and perfumes. The company does not want to raise money through debt because of the interest rate burden. This is when a private equity, PE investor, comes into the picture. PE investors are quite savvy. They are highly qualified and they invest large amounts of money. Fast forward 5 years after the PE investment, the company has progressed well, revenues are good, profitability is stable, and the investors are happy. The company now wants the brand available across all the major international cities, with at least 2 outlets in each major city worldwide. This is where the private company goes public. An IPO is a process using which a company can raise funds from the general public. When a company files for an IPO, they have to offer its shares to the general public. The general public will subscribe to the shares by paying a certain price. Now, because the company offers the shares for the first time to the public, it is called the initial public offer.